What if I told you that the 2008 financial crisis, the one that destroyed jobs, evaporated pensions, and wiped out entire neighborhoods, wasn't a mistake, a bubble, or a once-in-a-lifetime accident? What if the world's largest financial institutions didn't just predict the collapse? What if they engineered it? Because here is the truth nobody tells you. Banks don't make the most money when the economy is stable. They make the most money when you're drowning in debt, in fear, in confusion. And the story we were fed about 2008? Greedy bankers took too much risk. People bought homes they couldn't afford. Regulators were asleep. Cute story. Comforting story. Wrong story. The real story is a $10 trillion global wealth transfer executed through something almost nobody understands: the shadow banking system. The off-book financial underworld where banks earn money not by lending, but by creating money out of thin air. And once you understand this system, you'll understand why the collapse happened and why everything happening in the economy right now feels familiar. Before we start, drop your city in the comments because this crisis touched every part of the world, including yours. And hit subscribe if you want the unfiltered truth the news will never explain. Now buckle in, because what you're about to hear is the blueprint of the collapse that redefined your life without your permission. Most people think banks earn money the way they did 100 years ago. You deposit. They lend. You earn a little interest. They earn a little more. Simple, honest, almost cute. But that world died in the 1970s. The moment banking detached from actual money and attached itself to financial products, the entire industry transformed from shopkeepers into alchemists. Let's rewind. Act 1. Banking before the metamorphosis in the early 20th century. Banks were boring by design. Strict rules. Limited leverage. Few ways to create risk. But after the Great Depression, after the bank runs, after millions lost everything, the US government created strict boundaries with the Glass-Steagall Act. Retail, banking, and investment banking were separated. Your money was safe because the casino was kept far away. But power hates boundaries. By the 1980s, deregulation became fashionable. The financial sector lobbied, pressured, and argued that innovation was impossible if they were restricted. Innovation. Such a gentle, innocent word. And piece by piece, wall by wall, regulation by regulation, the financial system was open to a new era. Sound familiar? Because every major collapse in history starts the same way. With innovation, with efficiency, with modernization, with someone saying, "Don't worry, trust us." And trust, once again, became the most valuable and most abused currency in the world. Act 2. The rise of financial engineering deregulation enabled something new. Banks could now create money without deposits. How? Through a process called securitization, turning debt into products that could be sold. Mortgage, auto loans, student loans, credit card debt. Think of it like this. Instead of earning money slowly through interest, banks could now sell your future payments as a product and cash out instantly. The moment banks realized this, lending standards collapsed. Why care if the borrower can repay? Just package the loan, sell it, and move on. Sound familiar? We see the same pattern today in buy now, pay later exploding consumer debt, auto loans stretched to 84 months, credit card APRs hitting 30%, record bankruptcy filings. Because once banks learn they can profit more from debt creation than loan repayment, moral hazard becomes the business model. Act 3. From banks to shadow banks. By the late 1990s, traditional banking was too slow for Wall Street's appetite. They needed bigger profits, faster leverage, and fewer rules. Enter the shadow banking system. These weren't shady back alley banks. They were giant institutions, investment banks, hedge funds, insurance companies, and special purpose vehicles that operated completely outside regulatory oversight. No reserve requirements, no capital limits, no deposit insurance, no transparency. Shadow banks began issuing money-like instruments called repo agreements and used them to leverage themselves 20, 30, even 40 to 1. And what backed this new shadow money? Mortgage-backed securities. The golden goose. Which brings us to the heart of the story. Act 4. The fuse is lit. By the early 2000s, the US housing market became the engine of global finance. Not because people needed homes, but because banks needed mortgages to feed the shadow banking machine. So what did they do? They lowered standards, approved anyone, invented no-doc loans, reclassified risk as safe, bribed rating agencies with fees, and told the world it was all AA. Sound familiar? Because today's financial markets are doing the exact same thing with corporate debt, private credit, AI-driven lending, synthetic ETFs, and everything built on leverage. Every era repeats itself. Only the packaging changes. Act 4. The Global Trap. By 2006, the entire world was holding U.S. mortgage products. Germany, China, Japan, France, the UK, everyone bought the lie. Because the returns were too good, too consistent, too engineered. And then, the machine stopped. House prices stalled, then dipped, then cracked. A trillion-dollar market built on the assumption of forever growth began to unspool. But here's the part you were never told. The collapse didn't start in American neighborhoods. It started in the shadow banking system, in the repo markets, in the derivative contracts, in the liquidity pipelines where elite institutions had placed trillion-dollar bets. The public collapse was just the smoke. The real fire was hidden. And the fireproof suits? Only the elites had them. Everything you know about 2008 starts with the wrong question. The question isn't, why did the housing market crash? The real question is, why did the shadow banking system collapse all at once globally in less than 72 hours? Because that's where the $10 trillion wealth transfer happened. Here's the twist. The mortgage never mattered. The borrowers never mattered. The homes never mattered. What mattered was the derivative bets placed on top of them. Credit default swaps, CDS, synthetic CDOs, repo collateral rehypothecation. Trillions in leverage built on the same tiny pile of mortgage were used again and again like counterfeit currency. And who engineered this system? Just a handful of names. 3 investment banks, 2 rating agencies, 1 insurance giant, and a network of private financial entities that never appear in public reports. And the most important name of all? You won't believe the name. The receipt is wilder than you think. To understand how banks really earn money and how they engineered the greatest crisis of our lifetime, you have to forget everything you were taught in school. Because banks don't hold your deposits. They don't lend out your savings. And they definitely don't make money simply through interest. Those ideas are relics, fairy tales told to keep the public calm while the real game happens behind mirrored glass. The modern banking system has 3 engines of profit. Engine 1: money creation through lending. Here's the secret. When a bank gives you a loan, it doesn't take money from a vault. It creates the money. Type a number into a system. Press enter. New digital money appears in your account. This isn't conspiracy. This is standard accounting. Banks only need a fraction, sometimes less than 10% of actual deposits to multiply the rest into new credit. If you borrow $500,000 to buy a house, the bank didn't give you $500,000. It simply invented it. And in return, you owe them real money, your labor, your time, your life. That's profit mechanism number 1. But it's child's play compared to what happens next. Engine 2: turning debt into products, also known as securitization. Once a bank creates a loan, it packages it and sells it to investors. That mortgage you pay for 30 years? It's probably been sold, repackaged, sliced into tranches, and sold again. The bank wins twice. Firstly, it earns fees for creating the loan. Secondly, it earns cash instantly by selling the loan to someone else. No risk, no waiting, no loyalty to the borrower. And if your income collapses, if the economy cracks, if you lose your home, the bank still made its money up front. Securitization taught the financial world a deadly lesson. The fastest profit is made not from responsible lending, but from maximum lending. That's how standards collapsed. That's how toxic debt flooded the system. That's how Wall Street became addicted to quantity over quality. But even this wasn't enough. The real money came from something far more dangerous. Engine 3: shadow money and derivatives. This is where the real conspiracy, the real collapse lives. The public thinks the 2008 crash was caused by bad mortgage. Wrong. It was caused by the derivatives built on top of those mortgages, and the secret banking world that used those derivatives as money. Let me explain. In the 2000s, trillions of dollars of mortgage-backed securities, MBS, were used as collateral in the repo markets, the funding pipelines of the shadow banking system. Here's how it worked. 1. A shadow bank, like an investment bank or hedge fund, wanted to borrow money. 2. Instead of going to a traditional bank, it entered the repo market. 3. It handed over a mortgage-backed security as collateral. 4. It received cash, often at enormous leverage, 20 to 1, 30 to 1, even 40 to 1. 5. The same collateral could be reused multiple times, a process called rehypothecation. Imagine using the same house to take out 40 different mortgages at once. That's what the shadow system was doing. Now, multiply that by trillions. This was the greatest financial illusion ever built. The shadow system wasn't creating wealth. It was creating confidence, which looks like wealth until someone stops believing. Let's hit the numbers, the ones that matter. 1. $67 trillion is the size of the global shadow banking system before the collapse. 2. $11 trillion is the estimated value of mortgage-backed securities used as collateral. 3. 40 to 1 is the leverage ratios used by major investment banks, meaning a 2.5% drop could wipe them out. 4. $700 trillion is the notional value of credit default swaps, CDS, insurance contracts on global debt. 5. 72 hours is the time it took for the global liquidity system to freeze once confidence cracked. These numbers aren't random. They reveal the truth. The financial system wasn't built on houses. It was built on bets on houses. And those bets were built on bets on the bets. And bets on the bets of the bets. This tower of leverage generated billions daily for elite institutions. But it came with one fatal flaw. If mortgage prices dipped even slightly, if enough borrowers defaulted, if enough institutions questioned the value of the collateral, the entire system would collapse instantly. And in 2007, it started. The Lehman moment wasn't the cause. It was the cover. We were told Lehman Brothers fell because it mismanaged risk. Wrong. Lehman fell because it was the first domino the system could afford to sacrifice. Here's what really happened. Institutions saw the housing cracks. Repo lenders demanded more collateral. Banks couldn't meet margin calls. CDS insurers panicked. Liquidity vanished. Lehman was simply the first body they allowed to hit the floor. Because every collapse needs a villain, a scapegoat, to distract from the real architecture of failure. While the world watched Lehman burn, the elites were already moving money billions at a time into safe assets, private vaults, and offshore accounts. The collapse wasn't chaos. It was choreography. If the system was collapsing, how did the elites make money? Simple. They positioned themselves so the collapse paid them. Here's how. 1. Credit default swaps exploded in value. If you bet against the system, you made a fortune. Hedge funds like Paulson & Co. earned billions. 2. Safe assets skyrocketed. U.S. Treasuries, gold, and cash substitutes ballooned in value. 3. Foreclosed homes were bought in bulk. Private equity firms bought American neighborhoods for pennies. 4. Central banks injected trillions through bailouts, liquidity facilities, and quantitative easing. 5. Consolidation. Big banks devoured small banks. Power centralized. This wasn't a crisis. It was a harvest. And every dollar extracted from the global economy came from lost homes, wiped out pensions, vanished savings, evaporated jobs, and collapsed small businesses. The wealth didn't disappear. It moved from the public to the shadow system. Oh, the elite. That's the secret of banking. They earn the most when you lose the most. And the system is already rebuilding itself today. Sound familiar? Here's the part most people don't want to hear. The next collapse will be faster. Because today's system is more automated, more globalized, more leveraged, more algorithmic, and far more fragile. Shadow banking didn't shrink after 2008. It doubled. Derivatives didn't disappear. They mutated. Mortgage-backed securities didn't die. They were replaced by corporate debt-backed, I-rated, synthetic financial products, even more explosive. And the banks? They're bigger, more concentrated, more interconnected, more too big to fail. The system has evolved into something beyond human control, a machine running on borrowed time, borrowed trust, and borrowed money. And as always, you won't know the truth until it's already too late. Because banks don't warn the public. Banks warn each other. They already see the cracks forming. Liquidity stress, record global debt, repo market spasms, commercial real estate collapse, sovereign defaults rising, consumer credit strangling households. The signs are everywhere. And when the next liquidity vacuum hits, the transfer won't be $10 trillion. It'll be multiples of that. So I'll leave you with this. If the financial system was built on illusions yesterday, if it's built on even deeper illusions today, what makes us believe tomorrow will be different? Are we learning? Or are we simply reliving history with better graphics? Drop your city in the comments. Share this video with someone who still trusts the system. And hit subscribe if you want the truth before it becomes another headline. Because the final question isn't, how do banks earn money? It's, how much will it cost us the next time they do?